Jim, in your book, Mad Money, you say at this point in the cycle, we should be buying financials. What do you think? Are you not following your own lesson?
Frankly, let's be really candid. Because of my belief in my book and my work, I was buying Goldman Sachs and Citigroup and Fannie Mae for ActionAlertsPlus.com, and I still believe in those because I believe at this point in the cycle, when you got the decelerating growth, you should be buying financials. The missing piece of the puzzle is that the Fed's supposed to be cutting right here, which is why the stocks have lagged. In the interim, while I've been waiting for the cut, what's happened, the only cuts that we've had are estimate cuts. But we just got our first estimate cut today from Wachovia about the banks. If you don't own any of these banks or brokers, you don't need to. Not right now, you don't. Because we just got the word that the Fed's not going to cut for a little while. So, you can wait for another decline. The market hit on my sentiment indicator, which is the S&P. It's a proprietary oscillator. You got to pay for it with McGraw-Hill. We hit -7 on the oscillator. It's the most oversold we've been in the last 8 years. I've always tell people you can't be short then when we're that oversold. Of course, people stayed short. They stayed short Goldman and Lehman and Merrill, which was stupid. Unless you think those companies are going out of business, you should not stay short them. Now the short squeeze is occurring. These guys are frantically buying them. Great chance to lighten up if you're a trading-oriented person on Goldman, on Citi, and I like these stocks. I own them for. I'm not lighting up because I can't, but if I were a trading-oriented person, I'd be lighting up on all of these. And as they got higher, for some of them, I would be buying puts. I'd honestly be buying puts so that. And what I like to do is go out 6 or 7 months, so that when the decline happens again, and it will, when more estimate cuts occur, then you're going to catch a bottom. We're not at a bottom yet, unless you know that the Saudis are going to buy a big firm, Buffett's going to buy a big firm, or the Chinese are going to buy a big firm. And then all bets are off, and I'm going to be wrong short term that these were lighten up. But I'll be wrong long term. Maybe I'm trying to get it both ways for ActionAlertsPlus.com. So what I'm saying here is, historically, you should be buying them. Because of the credit risk, you can't buy them. The credit risk is unfathomable, but it certainly is going to hurt their numbers. We had our first estimate cut today for the brokers. When everybody cuts their estimates and downgrades, and what do I mean cut estimates? Right now people think that Goldman's going to earn, say, 20, which is what they earned last year. I need to see an estimate that says they're going to earn 15. If I see that they're going to earn 15, then I wouldn't even hesitate. I would just go buy Goldman. But until I see that big estimate cut, it is quicksand. And anybody who wants to step on quicksand is going to have to keep buying until they're drowned. So my take is not a good time for the financials, good time to sell the financials. As they go higher, good time to buy puts on the financials, and then we get the estimate cuts, then you got to cover the financials, and then once all the estimate cuts are made and the downgrades are made, then you can buy the financials.
Okay, lighten up on those financials. Jim Cramer, Brittany Umar, Wall Street Confidential.